In this very important special report, we are going to talk about the earnings analysis offered by Stock Traders Daily. We're going to compare that directly to the analyst expectations for the EPS growth rate for the S&P 500, and we are going to identify massive differences between actual earnings and analysts' expectations. My name is Thomas Key, and I am President and CEO and the Chief Market Strategist at Stock Traders Daily. And about 1 year ago, we began a project that focused on evaluating earnings. It wasn't just for the S&P 500, though the S&P 500 is important, but we also evaluated all of the sectors, the Dow Jones Industrial Average too, and we furthered that by allowing us to look at stocks of various sizes. We have this dated back to 2009, the beginning of the recovery, the end of the recession. And the evaluations tell us something about earnings, not only earnings growth, but also earnings as that compares to analyst expectations. That's the purpose for this particular review. The inception of this earnings project was prompted by what the investment rate told us. This is a snapshot, a very close-up view of what the investment rate is telling us. It told us that 2007 obviously was the peak in the net liquidity, the real liquidity based on the demographic study that is the investment rate. It told us that it was the beginning of the third major down period in U.S. history, and that the natural growth of our economy tapered off, to use a term we're familiar with today, until about 2012, when it started to decline much more aggressively. So my reading was that as 2012 came to an end, the growth rate that we had been witness to post the recovery would normalize. Instead of those eye-popping growth numbers that come after major setbacks like that recession from 2008, the recovery numbers are eye-popping. My assessment was because the natural growth rate in our economy actually gets substantially worse after 2012, and it is, by the way, getting substantially worse today, that those earnings growth numbers would not keep pace. They would normalize, even with the stimulus of the Federal Reserve. So let's see how that panned out. We're going to evaluate this in two ways. First, I'm going to look at what the Standard & Poor's company offers based on the S&P 500. This data comes directly from Standard & Poor's. And it shows us that after the recession ended, 2009, we had eye-popping earnings growth in the S&P 500. In fact, that lasted until about the second quarter of 2012, which is almost exactly when we began this earnings project. And since then, the earnings growth of the S&P 500 has flatlined. This was exactly what we expected when we began this earnings project, and it's supported by data from Standard & Poor's. But there's more. This is data that comes directly from our earnings project, this time for the Dow Jones Industrial Average. And it is the second quarter of 2012 that we're looking at here. We can see some real nice growth numbers from the Dow, about 11.5%. Revenue growth is nowhere close to that, but hey, earnings look good. 11.5% in the second quarter of 2012. If I change that to the third quarter of 2012, it tapers off a little bit, doesn't it? And this is, again, when we began this earnings project, when the investment rate told us that natural growth rates would taper. Well, revenue it's actually contracted in the third quarter of 2012. Earnings growth, only about 3.5% now. What about the fourth quarter for the Dow? Actually has a negative EPS growth rate with revenue growth of less than 1%. I got to switch this back manually to show the first quarter of 2013. And here it is. The first quarter of 2013, 1.4% EPS growth and a negative 2% revenue growth. And then let's look at what we have in the second quarter thus far. It's still not good. 0.6% EPS growth for the Dow Jones Industrial Average with negative 2.66% revenue growth. The data from our earnings analysis is supporting what the S&P 500 data shows, and it's also supporting what the investment rate told us would happen a year ago when we began this earnings project. But I want to offer some more detail here just so you understand that this isn't a mistake. It isn't an anomaly. We know something about this season, don't we? We know that the financial sector has been killing it. Great earnings numbers. Well, you know what? Our earnings project showing that that's exactly the case. Financials have been killing it. We also know, don't we, that materials have not been doing well. Well, our earnings project is showing us that too. Materials have not been doing well. I'm showing you this so that you understand that when I show you a Dow Jones Industrial Average that is barely growing at all, it is not an anomaly. These are real growth rates. And they tell us that those eye-popping comps, they don't exist anymore. And if the investment rate is right, we're going to continue to struggle to show the results that analysts currently expect. So what do they expect? This data shows us what analysts expect earnings to be for this current quarter. It's important to note that the data from our earnings report are for as-reported data. It's the as-reported earnings that are more of an apples-to-apples comparison to our earnings data from our earnings report. It's not the operating earnings, okay? It's this number. And based on current analyst expectations for this current quarter, they are expecting 17.72% earnings growth versus the same quarter of last year. Versus the same quarter of 2012. They're expecting massive earnings growth. The problem is, that's not what we're seeing. I'll be very specific by going back to our earnings project and looking at the S&P 500 results. And I'm going to do that next. But make sure that you understand that even with these lofty numbers, we're looking at a PE multiple of 18.67 for the S&P 500 based on where it closed on Friday. Also, make sure you understand that the estimates for the next 5-year annual growth rate for the S&P 500 is 11.12. They're estimating that the growth of earnings for the S&P 500 averages 11.12% annually for the next 5 years. And if that is true, based on the operating earning multiple, we're looking at a PEG of 1.54. In fact, we should actually change this to 17.21. There has been an update. 1.55 PEG. PEG is a valuation ratio for the market. They're looking for 17.72% year-over-year growth, price earnings multiple of 18.67 on an as-reported basis, but given the operating earning multiple and the 5-year earnings growth estimate of 11%, PEG is 1.55. This data is very important. It's very important because what if they're wrong and we're not growing at 17.72%? What if they're wrong? How does that change the valuation metric? Let's go back to our earnings analysis and select S&P 500. The results might actually surprise you. The growth rate for the S&P 500, EPS growth rate, is only 0.69%. Revenue growth of 2.85%. But analysts are calling for in excess of 17%. Earnings growth is 0.69% versus 1 year ago for the S&P 500. It is nowhere close to what they're expecting. And that's a big problem. Their current estimates are still inflated. But I might add that analysts are very slow to react. This graph shows the change in the estimates for earnings for the S&P 500 from last year. The earnings have been coming down steadily. Analyst expectations have been declining steadily for the entire year since the same period of last year. So that brings in their expectations for the next year. And that allows us to question those. Are those growth estimates warranted? But in addition, when will they actually adjust the numbers to accurately reflect this current quarter? Because this current quarter isn't living up to expectations. It's not over, but it's not living up to expectations, not even close. Analysts are renowned for ratcheting down their estimates by being overly optimistic. That is evident based on what they've done over the past year for this S&P 500 estimate. But what about the future? What about the current quarter as well? Let's go back to these formulas and this 17.72% expectation. I think we can reasonably assume that we're not going to get to 17.72%. So, what if we calculated it to be what it actually is? Last year we came in at 21.62, so what if we had 1% growth? Let's do 22, just to be nice. How does that change the valuation metrics? If earnings growth came in at 1.76, it's not over, so we don't know what the actual earnings growth for the S&P 500 is going to be. We know that is 0.67 now, so I'm being generous here. With this number, the price earnings multiple for the S&P 500 today increases to 19.4 times earnings. That is a very rich market, especially for a market that is not growing, at least whose earnings are not growing like they used to be. And there's the catch, I think. I'll talk about this some more. But because earnings growth after the recession and during the recovery was so great, they were eye-popping results, analysts might have a hangover, and they may still be expecting these lofty numbers. In fact, look at what they're expecting for the next few quarters. They're expecting massive growth. I mean, that's just ridiculous. That's the growth they're expecting now, when that was the growth that we got after the recession. But analysts are known to take down their numbers. So it's okay to question that, right? And it is. But I think it's important for us to look at something more than just what today's results are. Because today's results, they may change next quarter. So what's the average growth rate for the market? The investment rate's telling us that we're likely to revert back to the mean, even with the federal stimulus. We already know that the actual numbers for the S&P 500 have tapered off. Our earnings project shows us that the same thing is happening for the Dow Jones Industrial Average. So what's the growth rate over time? What's the norm? Well, interestingly, between 1988 and 2013, the average annual growth rate for the S&P 500 is 17%. And that's pretty close to what they're expecting going forward, right? They're expecting this 17% return, just about, pushing 20%, we'll call it, for the next few quarters. Reasonably, they're also looking for 11% growth for the next 5 years on average. And at first glance, that might tell us that this number, they're actually being conservative maybe with their 11%, right? Let's peel back the layer, though. When we look at the growth rate between 1988 and 2007, in other words, up to that recessionary period, we're looking at a growth rate that annualized at about 6.59%. Over this much longer time span, we saw a growth rate of 6.59%. But during the last few years, the recession and the post-recession results, EPS growth was in excess of 58% annually. That's skewing the number considerably. Right now, they're looking for growth for the next year of about 21%. That is higher than what it has been between 1988 and 2013 on average, but it is substantially higher than what was the norm prior to the recession recovery. And that's the point that I'm trying to drive home here. Earnings growth has stalled. We identified it happening a year ago. It is true in the Dow Jones Industrial Average and in the S&P 500. And we would expect a normalized growth rate much more in line with these numbers over time as a result. But they're looking for something much higher now, for the next year at least. And they also look for numbers much higher than that over the next 5 years as well. Let's take a closer look at that again. These are the valuation metrics for the S&P 500. I'm using operating earnings here. I think it's important to do that. And we have a current price earnings multiple of 17.21 based on operating earnings. Still historically rich. According to Shiller, the mean is 15.49. So we're higher right now than we're normally based on the actual operating EPS results. Based on that number, we have a PEG of about 1.55. The question I'm raising is the validity of this 11.12% 5-year average expected annual growth rate. I'm bringing that into question because my analysis tells me that's not going to happen. My analysis tells me that the average growth rate is going to be much more in line with the norm, and the norm is about 6.59%. It's telling me that because of what the investment rate says, that is being supported by the no growth that exists in the Dow Jones Industrial Average and the S&P 500. But analysts are very optimistic. They've been known to ratchet down their numbers. They have not yet done that for this current earnings season. But what if? What if analysts actually reverted back to what the norm in annual growth would be? Given where we stand right now with this price earnings multiple of 17.21, if analysts projected growth decline to what it should be as far as the norm, as far as the investment rates considered, which is still generous given what kind of growth we have not seen over the past year, that PEG ratio jumps to 2.61. And that is expensive. 1.55 is already pushing the envelope a little bit. Not too bad. But 2.61 is way out of whack. So I did a little calculation as well, and I asked myself, if we had to get back to a PEG ratio that was on par, let me change that back to 1.55. There have been updates to this data, slight ones. So if we're going to get to a PEG that's on par with where it is today, with growth estimates that are based on the norm, not reduced to the low level below 1% that we're actually seeing, but let's do something that's reasonable and get to the 6%, 6.5% range, which is the norm. What would the operating PE have to be in order to match? The answer is 10. The operating price earnings multiple would need to drop by almost 70% in order to match what it should be if forward estimates were reduced to normalized numbers, like the investment rate suggests they should be. And that draws me to a couple conclusions. I have a best case and a worst case scenario. The best case is based simply on a reversion to the mean. Sort of assuming that these growth estimates don't really change. That this 17.72% actually might come to fruition, maybe, or something close. Well, still, the mean is 15.49, and we're at 17.21, and we're rich compared to the mean. Best case scenario, I see an 11% pullback based on where we are without any adjustments. Worst case scenario, I see a 68% drawdown from the market. That would be this case. That would be a worst case scenario. that would mean that analysts need to come to the conclusion that earnings simply are not going to grow nearly as much as they had been expecting. And although no one believes that that's possible, it's definitely possible. If earnings growth expectations continue to be ratcheted down, it's going to get somewhere much more reasonable than it is today, at least. I mean, they're looking for this 11% number on an annualized basis. Normal growth is 6.59. Actual growth is less than 1%. Something needs to give. And I think it's these lofty expectations. I presented a best case. I presented a worst case. My gut tells me it's going to settle somewhere in between. But where we are today, it's much higher than where we should be from a market-based level. Much higher than where we should be. And we are set up for a correction at first. But if analysts get wind of this, the street starts to pay attention to actual growth rates, we could be set up for a market crash. Growth isn't even registering at par. Growth is less than 1%. That's a big concern. This worst case scenario is possible. My gut tells me we're somewhere in between these, but only time will tell. Right now, the market's rich. No one cares. But when they do care, I expect a significant drawdown. Please go to Stock Traders Daily now. Use the Utilities tab and the Earnings link in that menu to review the S&P 500 for the second quarter of 2013. And you can see how meager the earnings growth actually is. Thank you for your time. I hope you have a wonderful day.